This is a strict mathematical analysis. When you start investing at 16 with almost no money, the primary driver of wealth is the length of your timeline, rather than the size of your initial deposit. Society operates on a heavy assumption that building a portfolio requires a high salary and years of professional experience. If you run the numbers, that logic collapses. Teenagers possess a financial asset that billionaires cannot buy, yet they burn through it daily because the mechanics of wealth feel distant and abstract. To make this concrete, this diagram maps out a race between two people. On the top track, investor A starts at age 16, putting away £50 a month. At age 26, investor A stops. They never add another penny to this account. Their total effort lasts exactly 10 years. Investor B enters the picture at age 26. They also invest £50 a month, but they maintain that habit every single month until they turn 65, a full 39 years of consistent contributions. If you ask anyone on the street who finishes with more money, human logic points straight to investor B. 39 years of work feels like it should outweigh a brief 10-year sprint. To see why our brains get this wrong, we have to stretch our timeline across a 50-year market horizon. This line graph tracks the final valuations at age 65. Assuming a standard 7% average market return, investor B's reliable 39-year climb yields a final result of £116,000. Look at the second line appearing for investor A. Despite doing absolutely nothing for nearly 4 decades, their 10-year head start allows their total to surpass investor B at the finish line. The gap between them widens drastically in the later decades. While investor B is slowly adding capital, investor A's early money is multiplying at a rate that a monthly contribution cannot catch. This anomaly is driven by compound interest. It is the process where the returns you earn on your initial investment begin generating their own independent returns. Over extreme timeframes, compounding stops adding to your balance and starts multiplying it. The longer the timeline stretches, the steeper that upward curve becomes. The math confirms a stark reality. The sheer length of a teenager's youth holds more financial weight than the higher disposable income of a 30-year-old. Understanding the theory is only half the equation. Executing this in the modern financial system requires navigating a lot of noise. Many people assume starting a portfolio requires a massive upfront commitment. In reality, £50 is enough to activate the compounding process on most platforms. You also do not need to spend hours analyzing quarterly earnings reports or picking individual company shares. Because this strategy relies on a 50-year horizon, we don't need the extreme volatility of cryptocurrency to reach our target. The steady growth of the global economy provides the necessary momentum without that level of risk. This pie chart models the tool required, a simple global index fund. It is a single investment that thematically distributes your £50 across a basket of the world's most productive companies. Building wealth as a teenager does not require insider knowledge. The only genuine obstacle is the physical friction of setting up the account. Every single day you wait, that mathematical advantage is actively expiring. If you are ready to begin, the first step is to sit down with a parent or guardian and ask them to open a legal account in your name. Depending on your country, you are looking for specific accounts. Ask them to help you set up a custodial account or a junior ISA. If you cannot open an investment account right now, you can still train the muscle memory. The habit of setting aside that £50 is just as critical as the investment itself. While you wait for eligibility, park those savings in a high-yield savings account. It acts as a safe holding zone that generates a guaranteed return without exposure to the market. You can also open a simulated tracking portfolio. This lets you paper trade with fake money, so you understand exactly how market fluctuations feel before you risk real capital. The final numbers shift entirely based on the exact day you start. Drop your age in the comments right now, and I will show the exact calculation for your specific timeline in a follow-up video.